Most asset classes are down this morning with the S&P down 1.4%. The Nasdaq is down 1.1% as we speak as of close to noon Eastern time. Gold is relatively flat. Bitcoin is down 1.7%, and the US dollar is relatively flat. Treasury yields have declined as well. So what's happening? We'll talk about current market movement with our next guest, Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com, and what's coming up for us in the medium term. Welcome back to the show, Chris.
Hey, thanks, David. Always a pleasure.
Chris, a lot of volatility today to talk about. I think I'm reading on the news that a lot of it has to do with the fact that the CPI print didn't come in exactly as expected. So, as you know, the CPI report came in this morning, 0.2% increase in the prices last month. The annual inflation rate is now at 2.5%, the lowest level since February 2021. According to the CNBC article, economists polled by Dow Jones expected the CPI to increase to 0.2% in the previous month and 2.6% from a year ago. So economists with a consensus expectation was a slightly higher inflation reading, and it came in lower than expected, which may, according to this article again, which may prompt the markets to believe in a 25 basis point cut by the Fed next week. I think there was a higher probability of a 50 basis point cut at one point, but now that expectation is more or less gone. So that disappointed the markets. What's your take?
Yeah, so I mean, I focus on the price charts. To me, all the economic data like that is clear as mud. I mean, nobody knows what's going on. Even if it's like expected numbers, it's just the people who do those reports. It's what they expect. It's maybe not exactly what the general masses actually expect. So I don't look into it too much. I think the markets. I mean, a lot of people, I heard people before saying they expect the Fed to cut 1 percentage point, and others are saying 50 basis points, a quarter basis points. I really think, the Fed is playing a much bigger psychological game. They're not just tying it on to some economic data that comes out. I think if they do anything bigger than a quarter basis points, they're going to shock the system. I think it's actually going to be mentally, it's going to give the wrong impression. So I think they're going to do quarter basis points. Generally, I would think the data is probably going to support a quarter basis points. I think they're going to ease into it. They don't want to just go lopping off 50 basis points or one, because it's going to remove a lot of bullets from their gun when they need it down the road. So I think the markets are unfolding. The momentum in the last like 4 or 5 trading sessions has rolled over on the stock market. And I think the stock market's starting to sell off. I think it's primed and ready for actually a fairly sharp leg down, another 4 or 5% drop here maybe over the next week, just because it didn't get any traction last week in terms of reversing and recovering. So we are definitely seeing the market struggle here, and other assets are holding up like gold and bonds as a defensive play, which is nice. But the general market, I think, is struggling big time.
It's already been down about 4% since the last week of August, the S&P 500, that is. So when you say it's starting to roll over, are you talking about a bigger downtrend, or are you referring to the start of the correction, which really happened as of end of August?
Right. So if we take a look at my charts here real quick, like here's the SP 500.
Sure.
We've had a sell off over the past week and a half. It had a little bit of a bounce last week, and here we are, moving down again today, seeing a pretty big pullback. So if we were to just use some basic analysis just based on this drop using Fibonacci extension and this bounce, it tells us where this move should most likely go. So right now, the SP 500 is down as we speak about 1.10%. It has another about 3.5% to drop. And this is just a simple bear flag pattern, meaning it's dropped, it's created a little bit of a bear flag, which is a pause. It's also known as the halfway point. And then it has the second half of that move. So the market here is primed and ready. If we go and we look at the last time we saw one of these happen, it drops, you have a bear flag, and then it has the second half of that move. And you and I think we're talking last time or a couple of talks ago during that big volatility move in the market. And it was a perfect 100% measured move on the NASDAQ. And I think we're going to see another drop here in equities. And so that's when I say we're going to see a drop. It's only about a 3.5% drop, which is a lot, but I'm not talking about like it's the stock market like end, it's not the top of a major market at this point. It's just a consolidation, a pause. If we were to zoom out on the chart, this that we're having right here, might just be something like this. It just takes some time to consolidate or something a little longer. So it doesn't mean it's the market top yet. It just short term wise, the trend has turned down. Sellers are in control, and money is flowing out of equities and into different assets.
I want to take a minute to tell you about another way to be exposed to silver through mining stocks like today's sponsor, Dolly Varden Silver. Dolly Varden Silver is emerging as a prime silver mining investment opportunity as silver demand surges in 2024. Located in British Columbia's mining friendly Golden Triangle, the company offers high grade silver exposure in a low risk jurisdiction, making it an attractive play for investors seeking stability and growth potential. Industry heavyweights back Dolly Varden Silver, with Hecla Mining holding a 15% stake and billionaire Eric Sprott owning 10%, both signaling strong confidence in the company's future. Additionally, major institution Fidelity has invested 7.5%, further validating Dolly Varden's potential. Now positioned as a pure silver play in a safe environment, the company stands to benefit significantly from rising demand for silver. With top tier shareholders and a high quality asset, Dolly Varden Silver offers a unique combination of reward and security, making it a silver stock worth watching closely into 2025 and beyond. When you see a move like this, what we saw today, this morning, reflecting a data release, and like you pointed out, this may be the start of a bigger trend. Do you look at this and say, well, this is probably a short-term buying opportunity. It might bounce tomorrow because this data release is just, it's a one-off, right?
Yeah, it's somewhat news driven. I don't look at it as a buying opportunity. If the technicals on our analysis are giving us like red bars on the chart saying don't own the stocks, get out of the stock market, we don't try and buy it, pick a bottom, buy a dip. We'll let it bounce and rally and start a new uptrend, and then we'll get on board at a higher price, or we just let it fall and reset itself, and move into a different asset class that is going up while the stock market's out of favor. That's the whole point of what I do, is I just kind of reinvest our portfolio into whatever asset is moving up at any given time. So we're out of equities right now. We don't want to hold them, and we don't really care what they do now because we're not in them. We'll let them sort themselves out, and we'll be elsewhere until they give us a new opportunity.
So let's go back to your call about a bigger correction, just getting started. What indicators are you looking at to support that thesis?
Yeah, so there's a lot of different things. So, long story short, I mean, I believe we're in this kind of stage three topping phase, which is based around Stan Weinstein's theory. If people don't know it, they should check out the four stages from Stan Weinstein. But all the things are showing up here in the markets where we're seeing making new all-time highs. Energy stocks are up at major resistance where the market has topped out before. We have industrials at all-time highs. When all of these do very well, if you're actually to compile them together and look at them, these three sectors actually keep going higher or sideways while the stock market starts to top out and go lower. That's what happened in 2008. We've seen it in the past before other big bear markets. So these are just some high level signs that things are unfolding, where people are moving into gold is kind of a global emotional play. People are nervous globally. They're moving into it. Energy stocks, usually we have all kinds of chaos, uncertainty, war going on, something that keeps energy going higher, which oil, I think, is about to drop to like $40-$45 a barrel, and energy stocks are about to get annihilated. And then we have industrials, which actually gauges the sentiment of factories, of what warehouses are doing, upgrading assembly lines. And when we see industrials skyrocketing, meaning everyone's upgrading their facilities, their equipment, their assembly lines, usually that's the end of an economic cycle.
Hmm.
And poor factory owners don't realize they just spent millions upgrading and we're about to go off a economic cliff. So those three different asset classes kind of give us this warning. All of them are at those levels. We can see that in this cycle chart here, which is industrials, precious metals, energy are usually near top. And then if we flip to this yellow cycle, which
That's a
is
cool chart. I've seen the first chart a lot with you. I don't think I've ever seen this chart showing different sectors at different points in time. Yeah, this is cool.
right. So these are the three that are coupling together, really important right now. And if we look at the yellow cycle, which is the economic cycle, I mean, we have unemployment has broken through its 2-year moving average. Every time it's done this in the past, going like back to the 70s and before, we always have some type of major economic and stock market crash, some big reset. We've got full-time unemployment is starting to skyrocket. So people's jobs aren't just being trimmed back on hours. They're actually like, you're fired, you're done. Companies are like cleaning house, they're trimming up. We're seeing a lot of the business sales, business jobs. When we look at job openings, it's all in like there's fewer jobs. They're decreasing in manufacturing, in business services,
Mhm.
transportation, hospitality, luxury stuff. I mean, we're talking about the money is starting to tighten, and those are the things we're seeing. And not only that, but if you look at the excessive spending that investors have, they actually have burnt through their savings since after COVID, and now they're actually minus. And so we have unemployment going up. People have now burnt through their savings in the United States, the majority, and we're seeing credit card delinquencies skyrocket. The largest amount of people have ever had, like a 90 to 100% maxed out credit card and can't pay, is here. And we're seeing mortgage rates for residential and commercial having huge delinquencies. So, I mean, we're just on the cusp of everything. Like everything's really bad and brittle, and building pressure. There's about to be a break, and that's when, like, we're going to see the bottom fall out in the stock market, and
Mhm.
businesses are going to dry up, sales are going to dry up, people's are going to start closing their wallets because they're instantly going to see all this, be like, holy cow, prepare to, for a recession. So that's where I am in terms of the big picture, as you asked. I think we're in a stage three. The underlying things in the markets have eroded. They just haven't eroded quite enough yet. A little bit more time, and I think they like fall apart, and everything starts to slow dramatically.
The other thing we have to mention is I guess what the markets are pricing in after yesterday's presidential election. We have to bring that up. I'm reading, and I was thinking this as well this morning because I was following the debate last night, and throughout the debate, people on Polymarket, one of the world's largest betting sites, have placed higher odds of Kamala Harris winning throughout the course of the night. It started off as Trump having a lead, and then by the end of the night, I tweeted this as well. It was more or less equal, 49, I think 49% equal. So this morning, it possibly could be the fact that the markets are also pricing in a lower chance of a Trump win, which
Mhm.
for several reasons may be worse for equities.
Yeah.
Um, I'll let you respond to that. Do you think that's the case?
I mean, it definitely could be a factor. I mean, I don't follow any of that stuff, but I mean, obviously, big jump in
Sure.
taxes is gonna make investors like paying taxes on money you haven't even gained yet.
Sure.
I've heard some crazy policies that are floating around over in there in the States. So it'll be very interesting to see how things unfold.
Yeah, and Trump's Truth Network social media site, their shares traded lower as well. So people were using that as a gauge of probability of him winning. Okay, well, can you pull up a copper chart for us, Chris? And I want to illustrate a point that you just made. Um, if you just take a look at copper futures or the copper spot price, and the copper price, I pulled this up because people call this Dr. Copper. Uh, it's had a pretty good track record of signaling economic recessions or growth, both. And so over the last year, what you saw was copper spike up to $5 and then fall down.
Yep.
Um, Wait a minute, that's the you're looking at the futures right there?
This is copper futures. Yeah.
Okay. Um, so
Five
I think the
dollars.
futures are, yeah,
This
okay.
is the monthly chart. This is going way back so we can see long-term
Okay. I was,
resistance.
I was like, okay, why is that looking? All right, there you go. All right. Yeah, you're absolutely right. And if you look at the big red bar throughout 2022, that happened right before we had 2 quarters of negative GDP. So copper has been pretty good at calling declines. And so what do you think copper is signaling now? Does that match? Well, first of all, does the copper price here match what's going on with the cycles that you just talked about?
Yeah, I think so. I mean, copper typically tops out, and it shows weakness. I mean, it's a good sign of of economic strength. It's used in a lot of like wiring for housing and all that stuff. Typically, when we see copper go down, it's usually telling us, hey, the economy's starting to weaken. And I think you and I talked about this when it was way up here. I mean, it's right up at levels we've seen whenever, the economy tops out. We saw a very similar high level back just before the 2008 crisis. And of course, it went down. So a lot of people follow copper for the idea of things. This is one of those that does work. It's very similar like to the energy sector. So instead of using copper, I use the energy stock space. But to me, there's kind of the same thing. We've got, during times when the market weakens, 2008, we had some more weakness in 2014, 2015. We're back up into this nosebleed. This is very similar to copper. So you can flip and flop or look at both of them. But I do believe we're going to see, huge correction in pretty much every asset class, maybe other than bonds. Bonds could do very well going forward. And I think oil is about to collapse. Oil is on the cusp of a huge breakdown, which will also is kind of to me, is a leading indicator. If oil's underperforming, that means people see the economy slowing, less demand, and of course that's going to crush the energy stocks because their profits are going to go from having a profit to like taking a loss on every barrel they pump out. So there'll be a reset, and we'll probably see energy and copper and everything pull back into these levels.
You're not the first person to talk about potential oil price collapse. The other guest I interviewed, Doomberg, was talking about it more from a supply side as well. But if oil prices go down, Chris, would that not be, I guess, better for corporate margins if you consider the fact that oil is an input cost for a lot of different businesses, and if the input costs go down, margins could expand?
Yeah, I mean, I think low oil pricing is bad for oil or energy stocks, but I mean, it's great for the mining industry
Hmm.
because obviously it'll be cheaper to produce stuff. It'll be cheaper to pull stuff out of the ground. Obviously, anything fuel intensive, airlines, it'll be good for, it'll be amazing for the mining industry. So it does have its perks. Low energy pricing is great for everybody at the gas pumps, gives everybody more money every month. So there's ups and downs, depends on what sector or what you're looking at. So there's definitely pros. I mean, I like low oil pricing. Most of us do, but companies don't who rely on it. But so it depends on what side of the equation you're on.
Since we're talking about commodities, let's flip over to the precious metals now. Let's take a look at silver first. Silver. Oh, you have gold. All right. Well, yeah.
Sure.
Let's just talk about gold. You have it up on your screen.
Okay.
Uh, so yeah, gold has been on a steady tear. It's just continuing to go up. Slight increase this morning. Well, it was flat. Now it's up a little bit. Anyway, so gold is holding steady, and
Mm.
despite this volatility in risk assets, what do you think gold is signaling right now?
Yeah, so I think gold is signaling we are very close to a major financial reset. So, you and I have talked about this before.
Hmm.
The economy, the commodity cycle goes through these huge super cycles. We saw the start of a super cycle in early 2000s, and then it went into a multi-year pause. And then we saw everybody moving into gold as a defensive play back in 2007 and early 2008 as people were worried about the economy. They're worried about all kinds of stuff. We were kind of in a bubble phase. Well, we had a super cycle. The next super cycle started in 2019. We've had a multi-year pause, and now everybody around the world is moving into gold. I think a lot of people see the painting on the wall that things are about to roll over. And then after this, I do think there's a little bit of upside. I still think we're going to see gold hit around 2,700 an ounce. So there's about 5% upside from where we are. Very little upside. But then we're going to go in and see the stock market and the economy have a crash, and it's going to pull gold down. Gold fell 34%. I think gold from 2,700, I think it's going to hit that level. It could pull back down to the 2,000 mark, maybe even a bit lower and reset. And this is what you and I have been talking about for a long time, is I believe this is going to happen, that gold short term has been a great trade. I mean, we've been talking about 2,700 for a while. It's working its way there. I think it'll get there in the next few weeks, probably, or the next couple of months at least. But after that, it's like all bets off. We're going to a recession, stock market breaks down. We're going to see margin calls and just panic selling, and gold will probably pull back down to the 2000 level. If we take a look last time, gold pulled right back down to this breakout level, this pause before going higher. And of course, that is the 2000 mark, and it's the breakout level. And 2000 is a whole number. So naturally, if you're above a key whole number like 2000, people will say, well, if it falls to 2000, I'll buy some more, or I'll buy it again. So it's not only a resistance level on the price chart, but it's like a whole number where people will naturally be like, I feel like it's a bargain at 2000. I'm going to buy some. So 2000, like, 3, 6, 10 months from now, whenever, if it gets back there, is going to probably be a screaming buy because after that, we start to take off. So to me, gold is one of the best barometers of like where we stand in the whole economic cycle. It's way better than energy stocks and industrials and things. Gold to me is like the gold standard. It's the whole world's view. Silver and miners are like more of the speculator Western side world kind of different play, but gold to me is like the actual barometer of the health and the thought of the world kind of collectively, and it's telling us something bad's coming and they're moving
Yeah.
into it and we're close
I
to a
just
correction.
You can just keep that up for a minute. We're going to come back to gold and silver, but I was just thinking what when you talked about panic selling and margin calls. Remember back in early 2023, a narrative was people getting short squeezed that catch the push the markets up for certain period of time. Are you seeing any signs of that happening now? Are people positioned on the short side a lot?
I haven't been following the short side so much. I think a lot of the shorts are out of the market who are in it because it just keeps moving up. I mean, we might see another little bit of a short squeeze. Are you talking in gold or the equities markets?
Equities markets mostly.
Oh, okay, yeah. So I mean, if we take a look over at like SPY, I'm not really seeing any short squeeze. I think right now shorts. I think shorts are sitting pretty. I think they've got a good position right now. I think the markets look like they're going to have another leg down.
Mm.
I think the shorts got kind of squeezed out about 2 weeks ago when the market was up pushing these highs, testing these highs. Um, but yeah, I don't see too much of a short play.
Okay.
Anything screaming at me right now.
If you take a look at silver, for example, silver is an interesting metal because historically people talk about silver as being the poor man's gold because it has historically tracked gold quite closely. And up until basically a couple of weeks ago, it has. Recently, there's been a divergence. As you've shown in the previous chart, gold has maintained its strength, while silver, as you are showing right now, is losing that steam.
Mhm.
So is silver behaving more? I mean, I think silver is behaving more like an industrial metal than a monetary metal at this point, but what do you think?
Yeah, it's kind of stuck right in the middle. I mean, it's got a beautiful chart pattern. It's got a beautiful rally. It's got a multi-wave flag flagging down, which is good. This is pointing to higher pricing. This more recent rally that we saw over the past month and a half in this kind of controlled pullback looks very much so like it's the start of we're going to see another leg back up, probably 31, 32. So this has a bullish bias to it. This particular pattern. These here are bearish. This is bullish. So I do think it's starting to prepare to move higher. I think the stock market is going to start to struggle a lot more over the next month. And that's going to push seasonality and favorable conditions for both silver, gold, and miners. And in fact, just to touch on that really quick, if we take a look seasonality wise, now this is for the SP 500, and we look at September, typically the stock market sells off through September all the way to the end of October. So stocks should be going down. That's what everything else is telling us as well from the charts ourselves and our analysis. Now here's gold. Gold shows from September to the beginning of October it should rally. So we're very much in favor of gold breaking out and popping and running over the next more or less 4 weeks from now and hitting 27 or 2700 an ounce. So we're seeing the markets kind of crisscross here. Where like stocks are about to go down. This will probably, if gold gets traction, gold, silver, and miners should have like a nice pop and rally. But I think like this will be the last push up. After this, it's like cash out, wait for the reset. Gold, silver, miners will be a screaming buy probably late next year or whenever the market cracks.
Well, I think I've
That's
asked
how
you
I'm
this.
going to.
I think I've asked you this before, but during a recession, if the broad equities markets crash, um, why would the equities for the mining companies do well?
Well, they're not going to do very well. I think we're going to see, like, generally gold, like in this particular scenario with the stock market putting in a major top. And
Hmm.
I mean, like, this is very rare. The last time we really saw this was 2008. So this is not like a normal setup. So this particular setup, we're just in a sweet spot where gold, silver, and miners should continue to move up while the stock market potentially goes down here. Gold will perform the best percentage wise, which is why I keep preaching like gold is like low volatility, high guaranteed opportunity to make money. Silver will then also do well because they're both commodities. They're not stuck in the stock market. And as you know, I look at the stock market like the ocean tide. The stock market's going down. if there's a stock in it, it's naturally going to be pulled down. And that's why miners are last on the list because, yes, they're in the precious metal space. But if the tide is going down, it's naturally going to be pulling on those miners every day, fighting that, people moving into them, expecting precious metals to go higher. And so they're going to be very muted. In fact, miners make almost no real gains. They might hold their value, but they don't make any real gains versus if you just go to gold, the whole world's buying into it and it kind of drifts and runs higher and you get a better percentage. So, I mean, people naturally want to move to gold miners to try and make the most money. But in this scenario, it's actually the worst play to do. You're actually best to go to the most conservative one because that's where the big and smart money is going because they want something stable. They're not going to lose their shirts. Like miners can open up 5-10% down or sell off huge in one day. Gold does not do that. A big day in gold is like 1.5%. So there's a whole bunch of reasons, but to me, gold is the key play, then silver, and then miners, you're stuck with the overall market, always pulling on it.
Chris, anything you're really bullish on besides gold right now?
I do like bonds. I mean, bonds have finally turned a corner. We've got, I think, obviously a major bear market that has been in the bond market since the COVID crash. We've got all kinds of things kind of coming into play. The type of price action that we've had here, especially this last little bit, it's kind of hard to see these lines, but this kind of price action, more so like right in this area, is kind of a signature type of price movement of in the charts that usually signifies a bottom has been put in or is getting put in. And so, bonds, last time you and I talked, we talked about how bonds have finally kicked into an uptrend and they are on the verge of really starting to break out and starting to push a whole lot higher. So while the stock market has been like, moving up this entire time, bonds have been moving down and now we're about to see, I think the stock market start to come down and bonds are going to start to go up. So we're going to go back, reversion to the mean of historical price action of stocks go down, bonds go up, or bonds hold their value. And we haven't seen this obviously since 2020. So people are finally going to have like a breath of fresh air going, oh my gosh, at least some of my portfolio is going up while the market's crashing. Because, ever since till now, really, it's been like stocks are down, bonds are down. It's like a bloodbath. So we are getting back to actually normal type of market conditions that people, I think they're not going to be comfortable with it because I think we're going into a bear market, but we're actually getting back to the markets being normal in terms of how everything has moved in the past, which is great to see actually.
So, just to clarify, if you're bullish bonds, you're most likely then also you're expecting long yields to fall.
Yeah.
Okay. Very cool. Well, I think that covered a lot of ground. Oh, we have to bring up one last thing, the dollar. The DXY has been if you pull up a DXY chart, we can talk about that. Now, there's been speculation that the DXY could be even lower later on in the year because while the central bank of the United States, the Fed, is cutting, while the central banks of other countries are also cutting, and so relative to other countries, the DXY measured against other basket of other currencies may not necessarily retain its strength because everybody's cutting rates. Anyway, what do the charts show?
Yeah. So right now, if we look at the long-term picture of the dollar, the trend is still up. Long term, I mean, it's naturally working its way higher. We have a series of higher lows, a series of higher highs. And of course, there's long pauses through many of these. So it still is in a longer term kind of bullish phase. Now, if we look at the shorter term time frame, the big question, and we all want to know this, is this like a drop? And this is like, it's trying to build a base here, but this can also be seen if this base, the bottom breaks down, we're going to see another big push down and it'll sell off quite dramatically. So there's very much, the potential that we actually see a leg down from here. And in the grand scheme of things, it will most likely still be a higher low, which is good long-term. But overall, I mean, I don't know how it's going to react. We just really have to see how it's going to go, but it has some mixed signals. Long term, I think it's still actually going to go higher. When the stock market rolls over, we go into an economic recession, I think it'll turn back up and rally. But short term, it might have another wash down low and kind of complete this measured move to the downside and cleanse itself before taking off.
Well, Chris, let's inform the audience a little bit more of your work. So your strategy revolves around what you call asset investing, and I think people can learn more about that in your book behind you. But
Yeah.
also just visit the website link down below. You can learn more about Chris's work. But tell us a little bit more about your strategy and how that strategy pairs with the thesis you just described or talked about today.
Yeah. So the whole strategy is based around always reinvesting our capital into whichever asset class is favorable. So it's either we're long the stock market, or we're in the bonds, or we're into a US dollar, or we're in some type of cash position. Either way, we don't really diversify. We're only in whatever asset class is moving up. And so if the tide is going down in equities, we want to move to somewhere where the tide is going up, like bonds right now. That's a potential play. It trades ETFs. There's about 5 to 12 trades a year. As I kind of always explain, I look at the stock market like the ocean, and this strategy, I built it for my own money. So more or less everything that I do with my account is what I share with this strategy. And every year there's about 5 to 12 waves that roll through the market, just like a surfer floating out past the break. They're waiting for those clean sets of waves to roll through, and then they pick the wave that fits their position and their comfort zone and their board, all that stuff. And that's what we do. We literally float in the markets waiting for a wave to roll through, and then we hop on that asset, we ride it. And the nice thing about catching a strong wave is we also know when it's starting to weaken, so we can carve off, trim our profits, move our stops up. And once we're done, we just sit there, we wait for the next opportunity. And in fact, Friday and Saturday this week, I'm actually at the Toronto Money Show, Friday afternoon at 2:20. I'm talking about asset reinvesting. I'm on the main speech, and I've got some gold giveaways and all kinds of stuff. And anyone who attends the money show gets my book for free at the front door. And I have a booth so I can sign it. But I'll be teaching what asset reinvesting is. On Saturday, I'm doing a workshop at about 2:30, and talking about stocks, commodities, specifically gold, real estate, the economy, what's going on, the big cycles and trends at play, how to attack these markets. So if you're going to be in Toronto Money Show, you should come Friday, Saturday, and check it out.
We should talk about strategies for after the Canadian elections as well, because we're both based
Mhm.
in Canada. Excuse me. But yeah, we'll do that next time. I think we're getting closer to the Canadian elections. But okay, thanks for reminding me. People should check out Chris's work. The link's down below. And if you're in the Toronto area, of course, please go see Chris at his show this week. Thanks, Chris. Thanks for coming back on, and we'll speak to you soon. Cheers.
Yeah. Thanks, David. Always a pleasure. Take care.
Thanks for watching. Don't forget to like and subscribe.